Welcome to the Corporate Treasury 101 podcast. I'm Hussam.
And I'm Guillaume. In this podcast, we are going through the fundamental concepts of corporate treasury, which I learned from my experience working at a Big Four consulting company.
And he'll explain it in a way that someone like me who knows nothing about the topic can understand.
We hope you enjoy the episode.
Welcome back, Guillaume. How are you doing?
Hello, man. All good here. What about you?
I'm very good. Hey, our podcast is really shaping up.
Yeah, definitely. Quite happy about it.
People are listening.
Yeah.
We've even got some emails in. I don't know if I told you that.
We did.
People asking about more information.
Very good.
And telling us how amazing we are, actually.
Oh, wow. Just that. Man, super nice. No, but so glad the podcast is getting listened to. That's super cool. We obviously hope people are learning, right?
Yeah.
That's the very purpose of this podcast. And yeah, happy to carry on.
Well, let's do that. Let's continue. So we have taken everyone through, and you've taken me through, the foundations of corporate treasury, right? We broke it down into the 4 pillars: cash and liquidity management, corporate finance, financial risk management, and banking relationships.
Exactly.
Right? Yeah. And you said something last time, which I asked you to go a little bit deeper on, and that's exactly what we're going to do today, which was talk more about hedging, which you talked under the financial risk management section.
Indeed.
Right? So you said there was 2 types of financial risk potentially, interest rates risk and FX risks.
Yes.
Exactly. And you said companies hedge against that. So can you explain that concept to us today?
Yes. Absolutely, Hussam. So yeah, today we're indeed gonna go and do a deep dive into hedging. Just quickly, a little disclaimer and a piece of advice for the people listening. We highly recommend to listen to the full previous episode with the 4 pillars of corporate treasury. If not, at least the financial risk management part, because this is really the root of the episode of today. So there are indeed 2 main financial risks in financial risk management. The foreign exchange risk, right? When you are trading in different currencies, there are fluctuations between those different currencies rates and therefore a risk of losses. And interest rate risks. So obviously interest rates depend on many factors. Long story short, they vary over time.
Okay, great. So we said we would go into why companies would want to even mitigate that risk in the first place. So what does that mean, mitigating risks?
Yeah.
And why do companies want to do that?
Yes, that's a very good question. So let's start by the why indeed. So mitigating a risk is diminishing as much as possible the potential effect of a risk, right? So you do not decrease the risk, you just decrease the effect it will have if it occurs. So now, a very good question on the why. So corporations, companies are, and I'm going to state the obvious, in the business of making money, right?
Yeah.
So anything that makes them lose money is something they want to avoid, absolutely. Now, something we didn't detail last time, but in financial risk, there is obviously the risk of losing money, but with every risk comes an opportunity as well. So they might also win some, right?
So explain that to me. So how that work in FX risk, right? So we said FX risk. Last time you gave the example of having a company in the US, and you said, okay, if the exchange rate goes the wrong way, you lose money. I understand that.
Exactly.
But how do you earn money?
Yeah, absolutely. So we indeed took the example of a French shoes manufacturer, as you very well described, having a client in the United States. Let's take the same example as last time. The US client is going to pay us $120,000 in a month, which is, at the moment we are contracting, worth 100,000 euros. Well, so we agree on a contract for in 1 month to receive 120,000 USD, whatever happens. So now, if the US dollar loses value, I need more US dollars to have the equivalent of 1 euro. The 120,000 US dollars will be worth less when I receive them than when I contracted, right? So I'm losing money in that case. But it can also be that the US dollars goes up against euro. What does that mean? Well, it simply means that in 1 month, it can be that 1 US dollar will then bring me more euros than it does at the very moment we are contracting. And in this scenario, I will win money in a month because 120,000 US dollars will bring, let's say, 110,000 euros or 120,000 euros even. This kind of thing.
And exchange rates, they overall stay pretty flat, right? Meaning sometimes they go up, sometimes they go down. And that's probably, it could go either way, right? It's a coin flip. Exactly. Of course, there are macroeconomic events, political events that can push it one way or the other.
Yeah.
But it's 50-50 almost, right? So
very true.
One thing I don't understand about all this, you mentioned earlier bank relationships and banks are involved in the hedging process and we need to pay them money, etc. It all sounds pretty expensive and there's a whole industry there that I don't understand why it exists. If it's 50-50, you could go up, you could go down. On average, you'll stay flat.
Yes.
Right? So why do you need to put in the extra effort to have hedging mechanisms? Exactly.
Man, this is very on point indeed. So it will obviously depend on many factors. But first of all, I'd like to say that some companies are actually taking the bet. Some companies do that. They consider, okay, hedging is not for us. We do not want to either invest the effort nor the money. So we're just going to let the market flow and whatever happens. That exists. Now, indeed, most companies could think, okay, it's a 50-50, it's a gamble, let's take it, let's not bother. So this will highly depend on your risk appetite as a corporate, right? If you are willing to take risks with your business, with your money, it can bring some fruits, definitely. So it's worth taking some time. But other companies tend to go the other direction. So why is hedging important? There is a very fundamental principle for big corporations, which I think is important to break down here. What does a big multinational company want or even needs? Most of them, they need to grow, right? They need growth. Over the years, we always say, okay, we are growing yearly of that percentage of our turnover. They need to grow, ideally in a consistent manner, and preferably with expectable results. Now, most of those companies' leadership are not gamblers. They want certainty and predictability. Therefore, they will hedge themselves against risk of not earning as much or not enough money.
Okay, so it's all about risk appetite.
Exactly.
Right? So companies that are known, let's say, as safe companies like Procter & Gamble, or other big companies that are known for that, the boring companies to invest in, this is known, not the Teslas of the world.
Yeah.
You would say they're all about stability, they're low risk, they're more likely perhaps to hedge heavily.
Exactly.
As opposed to other companies which are a bit more wild cards. Okay, that's interesting. And that's that's what you said there, right? Predictability of growth. So if I assume then you're aiming for a 5% growth in a company, in your profits or in whatever else, revenues, then are you then risking not being able to go above that 5% just to secure that? So if I'm aiming for 5%, I'm like, okay, I'm going to hedge everything for this 5%. Potentially even, let's say, hedging myself out of gaining 10%, right?
Absolutely.
But you secure the 5.
Exactly. So again, that's very on point. And this is worth for all the part of the business, right? Not only the corporate treasury aspect of it. We're going to focus on this today. But indeed, some companies, and again, it comes back to the risk appetite. So they might sacrifice, between brackets, potential additional growth in order to secure the one they are targeting for. And this is especially the case of public companies, right? The one listed on the stock exchange. Why? Because they want investors to buy their shares, or eventually want to buy their shares. So in order to do so, they want their shares to be as highly valued as possible. And this is particularly the case of public companies, the one listed on stock exchange. Why? Because they want their value to be as high as possible to make the investors believe it's a good company to invest in, compound this effect in having a higher value, etc. So they want investors to buy and exchange their shares. And therefore, they want their shares to be as highly valued as possible. And they also want to distribute dividends, right, in a consistent, expectable manner. The key word here is reduce uncertainty and be predictable in the eyes of the world.
That's a really interesting perspective, right? So public traded companies where investors are watching them much more closely, they release projections at the start of the fiscal year or the start of the quarter even.
Exactly.
They're not so much measured on did they beat those predictions, but how good are they at predicting their growth and sticking to it, and therefore hedging becomes a really important financial metric then.
Exactly. No, that's totally it. Yeah.
Thanks.